Hi, I'm your accountant, and today I'll break down the most common business organization types: sole proprietorship, partnership, LLC, regular corporation, and S corporation. First, a sole proprietorship. This is the simplest setup: one owner, minimal paperwork, and you report business income on your personal tax return. The trade-off is liability. Your personal assets can be at risk if the business is sued or can't pay debts. Next, a partnership. This is two or more owners sharing profits, responsibilities, and risk. Partnerships typically file an informational return, then profits pass through to the partner's personal returns. A solid partnership agreement is essential so everyone knows who does what and how decisions get made. Third, an LLC, limited liability company. An LLC usually protects your personal assets while still offering flexible taxation. By default, a single-member LLC is taxed like a sole proprietorship, and a multi-member LLC like a partnership, but you can often elect corporate taxation if it benefits you. Now, a regular corporation, also called a C corporation. This is a separate legal entity with strong liability protection and easier access to investors. The downside can be double taxation. The corporation pays tax on profits, and shareholders may pay tax again on dividends. Finally, an S corporation. This is a tax election, not a separate entity type. An eligible corporation or LLC can choose S status, so income passes through to owners, helping avoid double taxation. But there are strict rules, like limits on the number and type of shareholders, and payroll requirements for owner-employees. Choosing the right structure affects taxes, liability, and growth. When in doubt, talk to an accountant and an attorney before you set it up.